The U.S. Federal Reserve has cut its key lending rate as expected. The cut 25 basis points to take the rate to 3.75 to 4%. Joining me now is Ian Wyatt, chief economist, Huntington Commercial Bank. Ian, thanks for joining us today.
Hey, thanks for having me, Marla.
So no official labor data for the Fed to really work with, but the concern still seems to be a weaker labor market. What did you hear from Powell on this?
Yeah, I think one of the interesting things is you really emphasize that a lot of the labor slowdown in terms of job growth is on the supply side. That was a big theme he talked about, was just this real big shift we've had in immigration, which, diplomatically he put it as it started under the Biden administration, has continued or accelerated under the Trump administration. So we have seen that real slowdown. So that makes it hard to know what the correct pace of job growth is. I don't think they're quite as negative on the outlook. There's a slightly improving tone they're hearing from companies right now in terms of their hiring plans. And, similar to what we're hearing from companies, it's, comp packages, typical comp packages maybe up 3.5%, 4% this coming year. So it's maybe not quite as negative as it was a few months ago.
Okay, that being said, we are beginning to hear more about layoffs. Is that a concern?
Oh, I mean, it's always a concern. Now, I think people sometimes have to put that in context that roughly 1% of U.S. workers are laid off every single month. Like, the amount of churn in the U.S. labor market is utterly remarkable. Especially for those of us in white-collar jobs, and we think of the lack of turnover we experience in our own jobs. But the reality is roughly 3% of U.S. workers change their jobs every single month. And about 1% so one-third of those workers who quit are because of layoffs. We haven't really seen overall layoff numbers spike yet, but it definitely is a little bit concerning when you're seeing some large bellwether companies announce layoffs.
Okay. Were there any other takeaways you got from what Jerome Powell had to say?
I thought it was interesting, his comments on strongly differing opinions he had for December cuts. In our in-house view, it's really December cuts. We consider the December cut to be baked in. We think, 25 is very likely in December, highly likely. You also do have a divided Fed. If you look at the dot plot, there were a number of governors, almost as many governors as wanted to get to one more cut by the end of December, who didn't even want this cut. Now, we had one dissent today on the not cut side. So that was Schmidt from Kansas City. Of course, Myron was a dissent for greater cuts. Where we have heard more hawkish comments prior to the September meeting really came from the regional governors. So it didn't surprise me that if we had a dissent, it was going to come from a regional governor, Kansas City being the dissent this time. So we've heard some more hawkish tone. I still think 25 is very likely in December, but this may portend, a repeating pattern from what we saw back in 2024 and 2025, which was we get to December, there's a cut, and you have a fairly divided Fed. So maybe the compromise between the crowd that wanted 3 cuts this year, which they'll get their wish if they get a cut in December, and the crowd that just wanted 1, is post-December we get a bit of a pause. That really could be a way, because the Fed is, to some extent, it's a negotiation between, Powell's job is basically to herd cats. It's a lot of very strong personalities, very strong opinions, but at the same time, they try to come to a consensus. So this could be, I think, very likely we may get a pause in December, and that may set us up in a pattern like what we saw in 24 and 25, where in the first half of the year, the Fed really doesn't move. Now, we expect there would be enough weakness in the data that maybe a little later in the first half, you get a couple more cuts. But I think the very likely scenario is 25 in December and then maybe a pause. And as Powell highlighted, still a very divided Fed, even if the votes don't appear to be divided.
Well, and that's if the data comes through. Like, that is the other part of it. We know that the data comes through and then gets revised, and that sort of changes the picture as well. So where's consumer spending at in the U.S.? How's that factoring in?
Yeah, so we look at the real-time card data. That's one of our things we always love, because we can see data from about a week ago once the card spending settles. And we saw it really picked up in June. We saw it really go from very soft to pretty strong spending growth in June, July, August. By mid-September, that started to slow a bit. It's still positive. It's still, when we look at that data, we're still seeing decently positive growth. Largely, as everyone's been talking about, there were many comments on the K-shaped consumer market. This spending growth really has been driven by upper income households. It's driven by older households. It's middle-aged and younger, lower-income households where we're seeing spending growth really is not keeping pace with inflation. So that effectively means that their lifestyles and they're having to really cut back on whatever they're typically spending on. But we're still seeing positive growth. I was talking to a bunch of auto dealers in Texas recently. They were still seeing, decent auto sales down there, pretty good auto sales, and people not only buying, but taking the higher end model and moving up. And I think that reflects that consumer who's a cash buyer and is often, pulling from or has a very large equity portfolio that's doing pretty well right now because the stock market continues to perform very well.
Ian Wyatt, so I got to leave it there. Thanks for your time today.